For this lesson, we shall focus on how we can analyze transaction that applies to a particular business into its effect on the assets, liabilities, and equity of that business. Now, this is essentially the effect on the accounting equation. Now, remember the accounting equation states that all assets that is owned by the business are provided by two parties, therefore is equal to the amount provided by external parties, we know it as liabilities because the business needs to repay back the amount owed, and the equity of the business, which is essentially the contribution by the owner. Alright, so let's begin looking at analyzing each of these transactions for the business of C Sun Apparel for the month of March 20X7 from the 1st all the way to the March 31st. Let's begin. On March 1st, Penny started business named C Sun Apparel with 26,000 cash. So in the asset category, the business will have acquired an asset known as cash in hand account. And this amount will be an addition of $26,000 to the assets of that business. Now this $26,000 asset is provided by the owner. So there is a name for this account, for this equity, known as capital. And the amount is the same, $26,000. Now you'll notice that there is no borrowings from external party, so no effect on this by this transaction. Let's look at March 4th, the second transaction. The business borrowed $10,000 from Best Bank. Now this money is inferred to be received in the cash at bank account. So in the cash at bank account, which is an asset of the business, there is an addition of $10,000. And this is provided by the bank, which is a loan, a borrowing from the bank. Okay, so the account is known as loan from Best Bank. And the amount is $10,000. Now there is no effect on the equity section, reason being that the owner did not contribute this $10,000. Let's look at the next transaction on the 6th. On the 6th, the business bought equipment. So the business actually acquired an asset known as equipment. So an equipment account, the amount is $12,000. And this equipment was bought on credit from White Furnishing. So therefore, it is actually a lending of monies by White Furnishing to the business to acquire this equipment. So this account is known as a trade payable account. And we need to identify who is a trade payable. And in this case, it is White Furnishing. The amount is increased. The amount owing is increased by the same amount of $12,300. And because the owner had nothing to do with this transaction, there's no effect on equity. Now let's analyze March 9. The business bought furniture. Now again, the business will have acquired a furniture worth $5,500. Now furniture is classified in a higher category known as fixtures and fittings. So there's a fixtures and fittings account, and the amount has increased by $5,500. Now this is provided on credit by Blue Enterprise. So for the same reason, we create a trade payable account, but this time the name of this trade payable is Blue Enterprise that we owe money to, the business owe money to. The amount owed is $5,500. So the liabilities have increased by $5,500. So we put a plus to recognize the increase. Now again, no effect on the equity section. Let's move on to the 13th. On the 13th, the business paid the amount owed to Blue Enterprise in cash. So your cash in hand account registered a reduction. Okay, so the reduction that you owe Blue Enterprise and you paid by cash is $5,500. So subtract $5,500 from your cash in hand account. Now, because what you owe Lu Enterprise and now it is paid, your trade payable amount owing to Lu Enterprise actually experienced a reduction. So instead of a increase, in this case now there is a reduction, a minus of the amount of 5,500 because you have fully paid it. Now again, the owner did not come into the transaction, therefore no effect on equity. Let's move on. On the 18th, Tenny contributed 4,500 to the business bank account as capital. So the business bank account, the name of the account is called Cash at Bank. This time the contribution amount is 4,500 and is contributed by the owner of the business, so it is capital. Recorded in the capital account, an addition of 4,500. Now, again, no external parties are involved in this transaction, so no effect on liabilities. Let's look at the next transaction on the 20th. Tenny contributed equipment. Now, when we see Tenny contributed equipment, it means she contributed her personal equipment to the business. So the business acquired an asset, which is an equipment, an addition of $1,500. Now this equipment is provided not by external parties, but by equity, by the owner. So the capital account increased likewise by $1,500. And again, since no external party is involved, no effect on liabilities. Finally, on March 31st, the business repaid Best Bank $1,000. Now, repaid means you have to pay out of your cash at bank account. Now, it's not clear whether it is using the cash at bank or cash in hand. So in this case, we will assume that it is using the cash at bank account to make the payment. So the cash at bank account, there's a reduction, so subtract a negative of $1,000. Now, what is it used to pay for? It is to reduce the loan from Best Bank that you recorded earlier. Now, so the liability actually experienced a reduction. So if you go to the account loan from Best Bank, instead of a $10,000 increase previously when you borrowed the money, now there's a repayment, so there's a reduction of $1,000. Now again, the owner does not come into the picture in this transaction, so no effect in the equity section. So in all, we have now come to the end of the transaction. Let's see everything in perspective. And we will see the following transactions. Now you will notice across every single transaction, the assets is always equal to the liabilities plus the equity. So for every transaction from the March 1st, the 4th, the 6th, the 9th, the 13th, and the 18th, the 20th, and the 31st. The assets, total assets that is owned by the business is always equal to the liabilities plus the equity, fulfilling the accounting equation.